You look around, and the only thing that we have hard evidence for buying is the central banks. Of course, the open interest on the COMEX has gone up, and it's gone up quite sharply in the last couple of weeks.
Right.
But those numbers themselves are not sufficient to account for the increase in the price of gold. So I think what we're seeing in gold, I think we're seeing, in addition to the central banks, gold is the beneficiary of China. So we've seen central banks this year, particularly February, March, we're seeing a pickup in Chinese buying.
With gold prices marking a record high for the 13th time this year, the metal's status as a safe haven asset is not solely driven by expectations for Federal Reserve interest rate cuts or geopolitical tensions. According to Adrian Day, founder of Adrian Day Asset Management, central bank purchases have emerged as a significant factor in bolstering gold prices. Day emphasizes that central bank buying activity has been the primary driving force behind the gold market's resilience. Data from the World Gold Council reveals that gold demand from central banks reached 1,037.4 metric tons in 2023, nearing the record high of 1,081.9 metric tons in 2022. This consistent demand trend underscores the enduring appeal of gold among central banks, with purchases surpassing 1,000 metric tons for 2 consecutive years. Despite this robust central bank demand, Day notes a contrasting trend in gold exchange-traded funds, which have experienced net outflows over the past year. The outflows from gold ETFs, amounting to about $4.6 billion this year, signify that ETF buying has not significantly contributed to the upward trajectory of gold prices. Global physically backed gold ETFs have witnessed outflows for the 9th consecutive month, shedding $2.9 billion in February alone. Day further highlights concerns regarding the fragility of the financial system, citing various issues such as commercial real estate challenges, delayed loan write-downs by banks, and insurance companies retaining risky assets on their books. Amidst economic uncertainties, Chinese consumers have turned to gold as a preferred investment option, particularly following declines in real estate investments, the devaluation of the yuan currency, and setbacks in the country's stock market. This shift in consumer behavior underscores gold's enduring appeal as a reliable store of value during periods of economic volatility. Come along as we explore the valuable insights provided by Adrian Day. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
First of all, no question that over the last 18 months, it's been central bank buying that has been the main support and overwhelmingly predominant support for gold. That's been what's driving gold. And if you look, frankly, at other indicators, other things that we have hard data on, like ETFs, well, I don't know what the data is yesterday. I apologize. Yeah, no, Monday, Tuesday, Wednesday, we had outflows from the GLD. We've had net outflows this year of about $250 million. And of course, we had net outflows last year. So it's not ETF buying that's pushing the price up. It's not ordinary retail buying. If you look at coin sales, for example, in both Europe and in the US, dealers that I have talked to all tell me that they've had a slight shift in the last month, but it's still basically flat, the difference between buying and selling. They tell me there is no rush to buy. There's very little net buying of coins,
Right.
and the premiums reflect that. So basically you look around, and the only thing that we have hard evidence for buying is the central banks. Of course, the open interest on the COMEX has gone up, and it's gone up quite sharply in the last couple of weeks.
Right.
But those numbers themselves are not sufficient to account for the increase in the price of gold. So I think what we're seeing in gold, I think we're seeing, in addition to the central banks and the Chinese retail, I think we talked about that last time.
Yeah.
That's picked up this year as people in China are concerned about the economy, concerned about the banking system there. They're taking money out of the banking system. And where the Chinese typically or traditionally put their gold, put their money, their savings, well, traditionally it goes into the stock market, which is very weak in China. Might be a good buy, but that's a different issue. You know, most people would look at it and be a little concerned about the weakness.
Right.
The second place they put it is real estate, where if you're Chinese, you're going to be very cautious about putting money into real
Yeah,
estate now. And
after
the
all the
third place is
craziness.
gold.
Yeah.
So gold is the beneficiary of China. So we've seen central banks this year, particularly February, March, we're seeing a pickup in Chinese buying. And I think the other thing would be over-the-counter buying, so it doesn't show up in reports, over-the-counter buying by wealthy families and individuals in Europe, in the Middle East, in the Far East,
Right.
in Asia, who are concerned, as you said, they're concerned about not just the geopolitical situation, but they're concerned, I think, about the fragility of the financial system. You look at the, commercial real estate, for example. Everybody knows it's a problem, but in the US, banks and insurance companies, for that matter, are able to continue to mark these things at cost until there's a default and they have to write them off. Japanese and German banks, which have exposure to US commercial real estate, and they have exposure in some cases to the very same loans, they're part of a syndicate. Well, the German and Japanese banks have been required by their regulators to write the loans down and in some cases off. And the very same loans that the Japanese banks are writing down by 50%, the US banks are keeping on their books at 100%, and the insurance companies are keeping on. So I think we're built, it's a defer, delay, defer, which is the US way of doing things, right? Just kick the can down the road and hope it goes away.
Yeah.
But it's a problem, and I think that's what you're seeing around the world.
Gold prices surged to new all-time highs above $2,300 during Friday's early New York session, defying expectations following a robust report from the United States Bureau of Labor Statistics indicating strengthened labor market conditions in March. The unprecedented rally in gold was fueled by a confluence of factors, including anticipation of a U.S. interest rate cut, speculative buying, and continued acquisitions by central banks, which sustained the upward momentum of bullion despite positive job growth data in the United States for March. This surge represents a notable 3.8% increase for the week, positioning gold for a third consecutive weekly advance. Given the recent market conditions, Adrian Day suggests a minor pullback in the gold market wouldn't be surprising. While a slight correction was observed recently, it is not anticipated to be significant in magnitude. Let's get back to the interview.
Would not surprise me if we see a bit of a pullback. We got a bit of a pullback today, not much. What's gold doing right now? Gold is down $5. It wouldn't surprise me if we got a bit of a pullback. But I don't think we're going to get a deep pullback simply because of the nature of the people who are in the market. If you're a wealthy Middle Eastern family concerned about the geopolitical situation, you want to protect your wealth, or if you're a central bank in Uzbekistan or wherever concerned about the US stealing your assets, you're not going to take profits because it's gone up $100, right?
Right.
Or $200. So I don't think we're going to see much of that. Well, with the big positive, I've mentioned that retail people are not in the market yet. They've only just begun to get back in. The ETFs, astonishingly, are still seeing outflows.
Yeah.
Gold funds are still seeing outflows. There's no mass move into gold, which is astonishing. But from a contrarian point of view, my gosh, what could be a better setup than this when in fact we're not seeing institutions, retail, rush into gold? I think when we see the broad market, and we look at the gold stocks and the silver stocks,
Right.
talk about them in conjunction. They've moved up a lot in the last month, no question. What is it, 30% or something? They've moved up a lot, 26%. They've moved up a lot in the last month. But the XAU, which is the index I tend to follow or I use as a benchmark, the XAU is still lower than it was a year ago.
Oh, so there's lots of room still to move.
2 years ago.
Yeah.
It's still lower than it was 3 years ago. And of course, we all know it's significantly lower than it was 10 years ago. So this move has only just begun. More likely at this point, because there is some concern about not the big money center banks, but there's certainly concern about some banks in the US. I think it'll only happen when they have to, when there's a default. And it's also private credit. You look at private credit, which is a market that has grown enormously over the last decade in the US, but also in other countries. And basically, with private credit, they're lending, they're making private loans or private equity,
Right.
and they decide their own marks, they decide their own valuations. In the case of some companies I could mention, like Gladstone Capital, which is a BDC that lends money to small businesses, Gladstone Investment, which lends money and makes equity in small private companies, they use S&P to determine the value of their loans. So they're using an outside firm, and many of the BDCs do that. But an awful lot of them don't, and an awful lot of private equity does not. They decide their own valuations. If you've lent, $1 million to a small business as a dry cleaner or something, you can just make up excuses why you want to keep it on the books at $1 million. It'll come back. It's a temporary thing. You don't have to change it until they stop paying you back the loan, right? And equity, of course, is even worse because they're not making payments. So yeah, there's a lot of, in my view, there's a lot of fragility in the system, a lot of underlying concern that is not seen on the surface, but could easily collapse it.
Gold has made a significant breakthrough above the $2,000 mark, marking a notable milestone reminiscent of the major event in 2005, when prices surged past the $400 level, never to return. While the current short-term outlook suggests that gold is overbought and due for a pullback, it's essential to recognize that prices often continue to rise despite being overbought in strong bull markets. However, employment reports can trigger a temporary setback if the reported numbers exceed expectations. Looking ahead, what key factors or events should investors monitor closely to navigate the evolving dynamics of the gold market effectively? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.